The global economy doesn't move on roads or runways, it moves on water. Right now, as you watch this, more than 11 billion tons of cargo are floating across the world's oceans. Clothing from Bangladesh, electronics from Taiwan, grain from Ukraine, oil from the Middle East. Nearly every physical product that crosses borders does so by ship. And today, those ships have become weapons in a conflict that could reshape the world economy. This isn't about missiles or military bases. It's about port fees, shipping taxes, and the invisible infrastructure that keeps globalization alive. What began as trade disagreements over semiconductors and solar panels has escalated into something far more dangerous: a battle for control over the arteries of international commerce itself. The United States and China, the world's two largest economies, are now locked in a maritime standoff that's already costing billions, disrupting supply chains and threatening to raise prices for consumers everywhere. And it all starts with a decision made in Washington this past spring. Act 1. The clash returns. For several months, the economic rivalry between Washington and Beijing had seemed to stabilize. Tariffs remained in place, but both sides avoided major escalations. Technology restrictions continued, but without dramatic announcements. It was an uneasy truce, tense but manageable. Then, in mid-October 2025, that calm shattered. On the 14th of that month, both nations simultaneously activated a new wave of financial penalties, targeting each other's maritime industries. But these weren't traditional tariffs on goods. They were direct charges imposed on ships themselves, vessels that carry the lifeblood of global trade. The timing wasn't coincidental. President Donald Trump had scheduled a face-to-face meeting with Chinese President Xi Jinping for later in the month, and both leaders arrived at the negotiating table armed with new leverage. Critics on both sides called the policies reckless. Supporters called them overdue. But regardless of intent, the impact was immediate and measurable. Consider the scale. Approximately 80% of all international trade depends on maritime transport. The clothes you wear, the phone in your pocket, the coffee you drink, almost all of it spent time on a container ship. When those ships become more expensive to operate, every product they carry becomes more expensive to buy. Industry forecasts released in late October painted a sobering picture. Analysts projected that these new maritime taxes could impose over $3 billion in additional costs on shipping companies within the next 12 months alone. And in an industry where profit margins are often razor-thin, that kind of expense doesn't just disappear. It gets passed down the chain, to importers, to retailers, and ultimately, to you. Already, shipping companies have begun rerouting their vessels to avoid the most expensive ports. Terminals that once processed hundreds of thousands of containers each week are reporting slowdowns. Freight costs on key routes have surged, and investors watching the sector are growing increasingly nervous. What started as policy disputes over technology exports and rare earth minerals has now expanded to the docks, the harbors, and the open ocean. Washington frames these measures as economic self-defense. Beijing calls them protectionist discrimination. But beneath the political rhetoric lies a deeper truth. This is a fight over an industry that China has already conquered and that America is desperately trying to rebuild: the business of constructing the massive vessels that power modern global trade. Act 2. The rise of China's shipbuilding colossus. China's dominance over global shipbuilding didn't emerge by accident. It was the result of decades of strategic planning, massive state investment, and an industrial policy that never wavered from its long-term vision. While other countries allowed their shipyards to decline, China doubled down. In August 2025, Beijing completed a merger that had been in development for years. Two of its largest state-owned shipbuilding enterprises, the China State Shipbuilding Corporation and the China Shipbuilding Industry Corporation, were combined into a single entity. The resulting company is nothing short of a leviathan controlling assets worth more than $56 billion, generating approximately $18 billion in revenue annually, and employing over 200,000 workers spread across 84 subsidiary operations. To put that scale in perspective, this single Chinese company now dwarfs every competitor worldwide. In 2024 alone, Chinese shipyards produced more commercial vessels than the entire American shipbuilding industry has constructed since the end of World War II. Let that sink in. Decades of American output, matched in a single year by China. According to data from CSIS, the industry's leading maritime research organization, Chinese yards delivered more than 53% of all global shipping tonnage last year. By early 2025, they held an even more commanding position in future orders. 62% of all merchant ships currently under contract worldwide are being built in China. The United States, by comparison, now accounts for just 0.1% of global ship production. Once a maritime superpower that built the fleets that won wars and dominated trade routes, America has been almost entirely sidelined in this crucial industry. But China's shipbuilding prowess isn't just about commerce. Many of its shipyards serve a dual purpose. They can construct commercial container ships and military destroyers under the same roofs, sometimes on the same assembly lines. This military-civil fusion strategy has turbocharged the growth of the People's Liberation Army Navy, which now operates approximately 370 vessels compared to roughly 295 for the United States Navy. Walk through the coastal industrial zones of Shanghai, Guangzhou, or Dalian, and you'll see new ships rolling off production lines every single week. These aren't small operations. They're vertically integrated complexes backed by state-subsidized financing and supported by supply chains so efficient they can deliver components from across the country within days. As China's shipbuilding empire has expanded, so has its global influence. Control over ship construction translates into control over international logistics, energy transportation routes, and even naval power projection. Beijing doesn't just build ships, it shapes the infrastructure of globalization itself. And while China strengthened its yards and expanded its fleet, Washington watched from the sidelines, searching for a strategy to slow Beijing's momentum. That search would eventually lead to an executive order that aimed to rewrite the rules of global shipping. Act 3. America's bold and risky countermove. In April 2025, the White House unveiled one of the most aggressive economic policies of Trump's presidency. The president signed Executive Order 14269, officially titled Restoring America's Maritime Dominance. The order directed United States trade officials to impose substantial new fees on foreign vessels entering American ports, with implementation set to begin on October 14th. It represented the first serious attempt in decades to challenge China's stranglehold on global shipbuilding and reassert American leverage over maritime commerce. The fee structure was, honestly, deliberately punitive. Under the new rules, every vessel owned or operated by Chinese entities must now pay $50 per ton of cargo. That rate will climb to $140 per ton by 2028. Ships built in Chinese yards but owned by non-Chinese companies face $18 per ton initially, rising to $33 by the end of the escalation period. For containerized cargo, the fees start at $120 per container and will eventually reach $250. Critically, vessels can be charged up to 5 times per year, meaning a single ship making regular trans-Pacific voyages could rack up millions of dollars in additional costs annually. The administration carved out a narrow exemption. Chinese carriers transporting American liquefied petroleum gas and ethane products can operate without these fees until December 10th. This exception reflects the reality that American energy exporters depend on Chinese ships to reach Asian markets, a dependency that itself highlights how intertwined the two economies have become. Trump framed the executive order as fulfilling a campaign promise to revitalize American manufacturing. He announced plans to establish a new federal office of shipbuilding, pledged incentives for domestic shipyards and promised to create thousands of high-paying industrial jobs. "We used to build ships in this country," he said during the signing ceremony. "We stopped, but we're going to start again." The rhetoric was confident, but the underlying numbers told a sobering story. In 2024, American shipyards completed fewer than 10 commercial vessels. China, in that same period, produced over 1,000. The shipyards that once stretched along the coasts of Maine, California, and the Gulf states now survive almost entirely on government defense contracts. Commercial shipbuilding in America has effectively ceased to exist. Economic analyses estimate that the United States commercial fleet now represents less than 2% of global maritime capacity, a stunning fall from dominance. Supporters of the executive order praised it as a necessary stand against unfair competition and state-subsidized overproduction. They argued that without bold action, American shipbuilding would never recover. Critics, however, warned of dangerous unintended consequences: higher costs for American importers, increased inflation for consumers, and the risk of triggering a broader trade war that could harm far more than it helps. But Trump was determined to demonstrate that Washington could push back against Beijing's economic might. That determination would soon provoke a swift and calculated response from China. Act 4. Beijing's Retaliation. Beijing's answer came just 4 days later, and it was every bit as aggressive as Washington's opening move. Starting October 14th, any vessel that is owned, operated, built, or registered under the flag of the United States would be subject to a new fee: 400 Chinese yuan per net ton, approximately $56 at current exchange rates. By 2028, that fee will more than double to 1,120 yuan, roughly $157 per ton. Like the American fees, China's charges apply for up to 5 voyages annually. But Beijing included a strategic exemption. Ships built in Chinese yards are exempt from these fees, regardless of who owns them. Given that nearly half of the world's dry bulk carrier fleet was constructed in China, this exemption protects a significant portion of Beijing's own global shipping business while maximizing pain for American operators. Chinese officials characterized the move as a justified countermeasure against what they termed discriminatory and protectionist maritime taxation by the United States. The Ministry of Commerce issued a blunt statement: "If Washington chooses confrontation, China will meet it at every turn. If Washington chooses dialogue, our door remains open." State-controlled media outlets escalated the rhetoric further, accusing the United States of violating an existing bilateral maritime transport agreement and undermining international trade norms. But China didn't stop at port fees. Beijing simultaneously tightened export restrictions on 5 rare earth elements: holmium, erbium, thulium, europium, and ytterbium. These metals are critical components in everything from electric vehicle motors to advanced defense systems. The announcement sent immediate shockwaves through commodity markets and drew a furious response from President Trump, who threatened to impose 100% tariffs on all Chinese imports beginning November 1st. Then came an unexpected escalation that demonstrated how quickly this conflict was dragging in third parties. China imposed sanctions on 5 subsidiaries of Hanwha Ocean, a major South Korean shipbuilding conglomerate. Beijing accused these companies of cooperating with American investigations into Chinese shipbuilding practices. Hanwha's stock price plummeted by 6% within hours, a stark reminder that even allied nations were becoming collateral damage in this economic war. For Beijing, the message was unmistakable. China was prepared to defend its shipyards, its strategic resources, and its market access, all at once, and with overwhelming force. As these tit-for-tat measures collided, the world's busiest ports began experiencing the first real consequences of this escalating maritime conflict. Act 5. Chaos at the terminals. The impact wasn't theoretical. It was immediate, measurable, and visible from space. Within days of the new fees taking effect, ships that had already departed from Asian ports began altering their routes mid-voyage. Freight tracking platforms recorded dozens of vessels suddenly changing course to avoid American harbors. Captains and shipping companies scrambled to recalculate routes, weighing the cost of additional sailing time against the expense of the new port charges. For COSCO, the world's fourth-largest shipping company and a state-owned Chinese enterprise, the financial hit was substantial. Industry insiders estimated that a single voyage on the company's Asia to West Coast routes now carried up to $2 million in additional fees. Those routes handle approximately 16% of all trans-Pacific trade, meaning the ripple effects extend far beyond one company's balance sheet. An industry analyst interviewed by international media explained it this way. Imagine a massive container ship carrying 10,000 containers. Under the current fee structure, that single voyage could incur charges exceeding $1 million. And remember, these fees are scheduled to increase every single year through 2028. Broader industry projections are equally alarming. The world's 10 largest cargo carriers could collectively face over $3 billion in additional port fees over the next 12 months. Bulk carriers, the enormous vessels that transport coal, iron ore, grain, and other raw materials, often weigh more than 200,000 tons. For them, a single port call can now generate bills ranging from $3 million to $10 million. For smaller shipping operators working on tight margins, these costs can eliminate an entire quarter's profit in one voyage. The ports themselves, which collectively handle roughly $200 billion in trade annually, are already feeling the strain. Terminal operators report declining container volumes. Thousands of dock workers, truck drivers, and warehouse employees are seeing their shifts reduced or eliminated. The infrastructure built to handle smooth, high-volume trade flows is now sitting partially idle. Shipping brokers describe the current situation as organized chaos. Vessels being swapped out at the last minute, cargo rerouted through Canadian, Mexican, or Panamanian ports simply to bypass the new charges. These workarounds add distance, time, and complexity to supply chains that were already stretched thin. Compounding the disruption, the United States imposed a 270% tariff on port cranes manufactured in China, along with annual equipment fees reaching up to $16 million. This creates a particularly difficult problem. The majority of American port terminals rely on Chinese-made cranes for their daily operations, and replacing them with domestically produced alternatives could take years, if American manufacturers can even meet the demand. Freight rates are climbing rapidly. Routes from Shanghai to Los Angeles or from Busan to Seattle have seen price increases of approximately 25% since mid-October. Importers are sounding the alarm that these costs will inevitably appear on retail shelves, driving consumer prices higher across multiple product categories. What the White House intended as a protective measure for American shipyards has instead created a cascading series of disruptions affecting every link in the global supply chain. Act 6. The cost at home. Inside the United States, the effects of this tariff escalation are becoming, honestly, impossible to ignore. Journalists covering the ports captured the mood in stark terms. In one widely circulated exchange on CNBC, a reporter described conditions at major terminals as ugly, noting that multiple sectors were being hit simultaneously by what economists began calling a quintuple tariff hit. That is, 5 major industries impacted by new duties on the same day. Lumber and timber imports faced immediate price shocks. Unfinished timber was taxed at 10%, while processed lumber faced 25% duties. By early 2026, those rates are scheduled to climb to 30% and 50%, respectively. The United States imports more than $12 billion worth of raw wood each year, predominantly from Canada. The furniture sector is even more dependent on imports, with over half of all furniture sold in America coming from China, Vietnam, and Mexico. Construction companies warn that the cost of building a new home could increase by $10,000 to $20,000 due to material price hikes alone. Major retailers are feeling the pressure. Walmart and Target have both reported freight cost increases of 20 to 25%. For now, these companies are absorbing part of the increase to avoid sticker shock for consumers. But with shipping fees continuing to climb and port surcharges piling up, even the largest retail chains admit they cannot maintain current pricing indefinitely. Goldman Sachs released an estimate projecting that approximately 55% of all tariff costs will ultimately fall on American households by the end of the year. In practical terms, this means higher prices for clothing, electronics, furniture, building materials, and countless other goods. The political fallout is building. A coalition of importers and logistics companies has filed legal challenges disputing the legality of Trump's tariffs. They argue that invoking national security powers under Section 232 of trade law stretches the statute far beyond its intended purpose. The Supreme Court is expected to review these challenges before year's end, a decision that could fundamentally reshape presidential authority over trade policy. Meanwhile, unemployment among minority workers, which had fallen to a historic low of 4.8% 2 years earlier, is beginning to rise again. As inflation accelerates and wage growth stagnates, the administration's promise to rebuild American industrial capacity is colliding with growing economic anxiety among working families. Act 7. Global Ripple Effects. Beyond American borders, the consequences are spreading rapidly across the world's interconnected trade networks. Shipping routes that carry 80% of global goods are being redrawn in real time. Major carriers, Maersk, Hapag-Lloyd, CMA-CGM, have begun swapping Chinese-built vessels out of their American service routes to avoid the new fees. Others are diverting traffic through alternate ports in Canada, Mexico, or Panama, adding thousands of additional nautical miles and weeks of transit time. Freight brokers report that by late October, these detours had driven trans-Pacific shipping costs up by nearly 30% compared to pre-crisis levels. Oil tankers are among the hardest hit. China's countermeasures affect approximately 15% of global tanker capacity, increasing costs for crude oil and liquefied natural gas deliveries throughout Asia. Some American owners have resorted to selling their cargo mid-transit to non-Chinese buyers simply to avoid incurring docking fees, a highly unusual workaround that distorts global energy flows and creates market inefficiencies. The impact on allied nations has been particularly striking. China's sanctions against Hanwha Ocean's subsidiaries demonstrate that even countries friendly to the United States can become targets. Hanwha, a South Korean company, saw 5 of its American-linked operations frozen out of Chinese contracts overnight. The company's share price dropped 6%, and its ability to compete internationally has been significantly hampered. An Athens-based maritime broker coined a term for what's happening: the maritime tax spiral, a self-reinforcing loop of retaliatory charges that traps two superpowers and ensnares everyone who trades between them. Port congestion is increasing. Insurance premiums for shipping companies are climbing. Logistics planners are warning of potential product shortages in early 2026 as supply chains struggle to adapt to the new normal. Yet amid all this tension, both sides continue to hint at the possibility of restraint. U.S. Treasury Secretary Scott Bessent has repeatedly stated that channels for dialogue remain open and that the threatened 100% tariff might still be averted. It's a fragile hope, especially with President Trump and President Xi scheduled to meet face-to-face at the APEC summit in South Korea. Act 8. What comes next? The coming months will determine whether this maritime conflict becomes a permanent fracture in the global economy or merely a pause before an even larger storm. China's newly merged shipbuilding giant, now controlling more than 60% of future global vessel orders, can absorb these increased costs far more easily than its competitors. The company benefits from state backing, cheap financing, and economies of scale that no private competitor can match. The United States, in contrast, is relying on fees and tariffs to defend an industry that no longer produces at meaningful scale. American shipyards lack the capacity, the supply chains, and the workforce to quickly ramp up production. Even with government support, rebuilding a competitive commercial shipbuilding sector could take decades. Several critical flashpoints loom on the horizon. The Trump-Xi meeting at the APEC summit could either de-escalate tensions or cement them. The threatened 100% tariff, currently scheduled for November 1st, remains a sword hanging over the entire trading relationship. And the expiration of China's exemption for American LPG shipments in December could trigger another round of disruptions. By 2028, if both countries follow through on their announced schedules, port fees will more than double, creating a permanent cost barrier across world trade. Economists warn that if tensions continue to rise, global shipping rates could surge another 40% in 2026, pushing inflation higher in every major economy. The world's prosperity still depends on open seas and free-flowing trade. But those waters are rapidly becoming politicized, weaponized, and expensive. Closing. The question that remains: what began as a dispute over rare earth minerals and semiconductor exports has evolved into something far more consequential, a fundamental contest over who controls the infrastructure of global commerce.